Hi, good evening, everyone. Thanks so much for joining today. So, yeah, it's 7 now. We should get started. So, my name is Sunny. I'm from the digital sales team at Saxo Market Singapore. So, your host for tonight's webinar, and a warm welcome once again. And thanks for taking your time joining us tonight. So we are happy to inform you that the today content that we brought to you by Saxo in collaboration with London Stock Exchange Group, LSEG, and we are honored to have here with us today Ms. Indrani, Head of a Global Investment Research, FTSE Russell, London Stock Exchange Group. So as you can see today, the topic is about value versus growth investing in UK equity. So hopefully after the session today, our audience can get some idea and also some trading inspiration in 2020 and even beyond. So, should you have any question along the way, do feel free to post them in the chat, and then we will addressing a few questions by the end of the webinar during the Q&A. So, before we begin, so this is the disclaimer to show the audience that the today content is that we are going to share with you is just for your general knowledge. So it does not include any financial advice. So please only trade and invest when you have read and also understood the risk. So our webinar today will take around 35 minutes, and this will be an agenda for today's session. So as you can see, the first 5 minutes, definitely I will walk you through a quick introduction about our Saxo Trader Go platform. And also there is a special edition today where we are giving out our free gift at the end of the session. So stay tuned. And followed by then, it will be a 20-minute sharing by Indrani from LHEG on the value of growth and investing in the UK equity. Definitely gonna be a very insightful session. So yes, hopefully you will enjoy it. And 5 minutes for Q&A. And last but not least will be some closing remark. And also I will redeem the promo code to collect your free gift. Okay, so let's get started with me showing you the Saxo Trader Go platform overview. So to access the Saxo Trader Go platform, there are two ways. It's really easy. So you can either go to the Saxo website on our website and then log in directly from the website, or you can go to www.saxotrader.com. So this is how you look like when you first log in to our Saxo platform. Okay, so for Saxo, we offer different platform for client access. So we both have on browser mode and also on the mobile app. So we easily download from the respective app store. So it will allow you as a client to trade on the go easily. So in the next few minutes, I will show you how to navigate around the platform, our award-winning platform, Saxo Trader Go. So this is one you first open, what you can see, 3 main tab. And for the interest of time, I will run through with you only the watch list and also the screener function that's available on our platform. So let's get started with the watch list at first. So if you want to build your diversified portfolio and then you want to select a different instrument across different asset classes, it's really easy. Just create a watch list and add the instrument accordingly so you can monitor closely. So how to create a watch list is really easy. The first tab on our Saxo Trader Go platform, just press new. And then let's name your watch list. Let's say LSEG, today our partner. Save the watch list. And then see you can have a new watch list, and after that you can search in the instrument and that you want to keep an eye on, monitor closely. Let's say for UK equity, the index, and also for the let's say some some ETF. Yes, that's how you add the instrument to the watch list. Just search for it and click, and then it will be added to your watch list. Or alternatively, you also can use the instrument search on the top right hand corner right here on the platform. So let's say you search for some product, let's say brand true, and then you can just click here. It will show you the full string under the product overview, and simply just click on the star icon right here and add to watch list. The watch list today I name as SEG. So just click here, and then here we go. It will appear to your watch list. So it's really easy. And moving on to the screener function, you will be looking for the range of product that you keen to trade. It's really easy. So after today's session, if you keen to explore about the UK equity, it's simply just go to the screener under the filter. You can just choose stock, and then you can just choose the country. Let's say United Kingdom, UK, and then yes, done. You will be able to see all the instruments that are available and in the last 3 months popularity trading by our client. And also you can add the instrument from the screener as well. So simply just right click on the instrument that you want to see. And then you will be able to see it right here. Yep. So after today's webinar, if you also keen to get more investment idea and also trading inspiration, you may take a closer look to a Saxo Research tab, where you can get on the hot topics, some last week trending by region on different instrument. Yes, so for Saxo, we also categorize the instrument based on their performance and also the Morningstar rating for your ease of evaluation. Okay, so with that, I might want to. Yes, I might want to show you a little sneak peek that we're gonna give away until the end of the session. So make sure that you stick with us until the end to get the promo code. And so with that now, an understanding of the Saxo Trader Go will bring me an honor to hand over the webinar to Indrani, who will bring us to today's topic again, value versus growth in investing UK equity. I will now pass the mic over to our partner speaker. Indrani, over to you.
Thank you, Sunny, and good morning, good afternoon, good evening, wherever you might be. So with that, I am going to jump into our presentation today. So I'm going to talk about the United Kingdom, and there are 3 parts to the presentation. One is the macro backdrop for the country. One is specifically on the equities in United Kingdom, and I would also touch a little bit on REITs, one of the industries, and obviously it has unique characteristics. Before I start, I do need to say, for compliance reasons, FTSE Russell is not an investment firm. Anything I talk about is not investment advice. It's just for educational purposes. Now, with that, I jump into the macro part. Now, the first thing that I do want to highlight is, as you compare the United Kingdom against the other economies, its peers in G7, the UK growth outlook is really the weakest. Now, if you see on the right-hand side, you'll see the IMF growth forecast for 2023 and done at various points in time, end of last year, early this year, and most recently in April. What we have shown in that circle is United Kingdom. You see, that's the only country that was kind of dipping into the negative territory. Now, most recently, they have kind of become a little more optimistic on UK economy, but nevertheless, IMF numbers show that the growth outlook for United Kingdom is the weakest within the G7 countries. Coming to the other main economic concern in today's world, inflation. Now here, it's again interesting. If you see the graph on the right-hand side, you will see that it has the inflation year-over-year numbers for the last couple of years for all the major peers, US, Eurozone, UK, Canada, Japan, China. And you see all the graphs have kind of peaked. So in all parts of the world, inflation has peaked and it's now coming down. What is most interesting for this particular discussion right now is the light blue line, which is the United Kingdom inflation. While it has also turned the corner from the peak, it is still the highest amongst its peers. So, and one reason this is happening is UK inflation happens to be, for various economic reasons, the most sticky compared to its counterparts, which means the more sticky the inflation, the harder it becomes to reduce it, which means the central bank in United Kingdom has to work that much harder to reduce inflation. So that's something to keep in mind. do want to highlight how the Bank of England is behaving. It's very similar to the Fed, and the extent of tightening right now in this cycle is much more severe than in the great financial crisis. Now, everything that I'm going to present in this deck, it's data as of April 30th, 2023. The only exception is here, as I've mentioned, even as recently as on May 11th, the Bank of England is still tightening. So what the Bank of England tightening has done is, while we talked about in the last slide, inflation has peaked, but it's still the highest amongst its peers. That's actual inflation. Another very important thing is inflation expectations. Where does financial market and consumers expect inflation to go? Now, the good part is that the tightening has stabilized these inflation expectations, and things are coming under control. So, and this is probably the last slide I'm going to touch upon on the macro part. I do want to highlight why is it so sticky in the United Kingdom. It's because inflation can come from two sides. It can be because of excess demand. It can be because of supply chain issues or, those kind of things. The point being, United Kingdom, it's not so much demand pull, but it's just sticky inflation because a lot of workers have left the labor force, wage growth issues, labor issues. That backdrop is what makes the United Kingdom inflation scenario much more challenging and much harder for the central bank to control that inflation without taking the country into a deep recession. Now, with that, let's go on to the equity market. Now, everything that we talk about in the equities, when I'm comparing United Kingdom with its peers, we are using what we call our GEES index series for the simple reason, the same index methodology, when you see performance in different parts of the world, it becomes a real apple-to-apple comparison. So that's why I'm going to be talking about FTSE UK, FTSE US, and so on and so forth. Now, this is the performance of the equity markets in the last 1 year, April 2022 through April 2023, rebased. Now, two important points are whether you look at the last 12 months or the current year to date, United Kingdom and developed Europe have outperformed the broader developed markets, the old world indices, and the United States. Now, this is something really worth keeping in mind because this is really a, should I say, turning point in how markets, equity markets have behaved since the great financial crisis, where United States was by far the leader. So now in the last 1 year, seeing United Kingdom and developed Europe ex-UK being the leaders, that's really a change from what we have seen in the for a very long time. Now, I must point out that these are returns rebased in US dollar. So the strong British pound this year is also part of this reason. Let's do a little deep dive into the UK equity markets. So what you see here is there are three columns. You're talking on the first, the industry weights. And when I say industry, I mean our ICB, the highest level classification of the equity markets into 11 parts. Those are the 11 industries. So on the extreme left, you see the industry weights, then the returns of those industry, and then the contribution of those industry weighted given its weight. And here we are analyzing United Kingdom, Europe ex-UK, and FTSE USA. What I clearly want to highlight on the left-hand side, you'll see those two circles around energy and technology. And I want to point this out. This is where most of the difference between UK equity performance and the rest of the world happens, because UK has a much higher weight in energy. And the other sector where it's very different is technology. UK has almost a negligible weight in technology, while US is very heavily into technology, almost 30%. So energy and technology, these are the industry weights in these two industries is really what is driving the difference between UK and its peers. And as we all know, in the last 1 year, energy, given the war and supply chain issues, energy is a industry in the news. Similarly, technology, anytime changes happen to the rates and rate expectations, technology gets impacted in a good or a bad way, depending on how rates are going. So these are the two industries in the news, and these are the two industries where United Kingdom has very different weights from its peers. This again pretty much highlights the same thing. The last slide was on the year-to-date numbers. This is for the last 12-month numbers. But I want to point out that the conclusion remains the same, whether you're looking at last 1 year or the last year-to-date, that it's energy and technology and those differences that's really driving the difference between UK and its developed world peers. Now, this is a slide I want to hold on for a few minutes because this is really fascinating. The extent of concentration in UK stocks, UK equity markets, just 10 stocks, and they are, as you see the names, AstraZeneca, Shell, HSBC, these are very global companies, but only 10 companies make up 48%, almost 50% of the UK equity market. So there is a very heavy concentration in the UK equities market. And you see that these top 10 names, they are concentrated in energy, consumer staples, healthcare, basic material, and financials. Now, let's go a little deep dive into the factor performance. So what this slide is doing, it's looking at how the factors are behaving relative to the overall index. Again, in the last 1 year, it's rebased to the last 1 year. And because everything here is right now about UK, it's in local currency. So the most important thing to see is value, the black line, value, which was doing so well. It had a very sharp drop as the banking crisis started in the United States in March. That's one thing that's really important to consider. The other line that you see, the very light blue line, which kind of drops much more than the other lines and then comes up, that's the size factor. And this size is very related, size factor, how it does is very related to the last slide we saw, that the top 10 names, really global names coming from those 4-5 industries, having 50% weight in the equities. That's why the size factor moves around a lot in the UK because of that heavy concentration by those 10 global names. Now, another thing I do want to point out as we are in the slide is you will see that we have a factor called quality, not growth. Now, in most parts of the world, quality, growth, they kind of become synonymous, but people think of growth, they think of technology. And given that the United Kingdom has such a low weight in technology, in some sense, it's better to measure that factor by the quality factor, which essentially looks at leverage and profitability. So the sharp turnaround in the value factor post the banking crisis, that is something we need to keep in mind. Okay, here again, we are looking at the performance of 3 factors in a little more detail. We are looking at the value factor. In the middle part is the quality factor, right is the size factor. And again, for the 3 geographic regions of UK, US, and developed Europe ex-UK, rebased and all that. So again, we see the same thing in much deeper clarity that with the start of the banking crisis, value factor started underperforming across all regions. Where things behave differently in the factor world, you see the quality factor. In United States and Europe, investors fled to quality. And as I said, quality is profitability and leverage. But in the United Kingdom, in the middle, where we are seeing the quality, you see the black line drop. And we'll come to this in a little bit, but it's interesting how the quality factor started doing very differently in other parts of the world relative to United Kingdom. Let's explore this in the coming slides. And this is where I really want to point out, this is a very interesting thing that What does quality factor mean? Again, coming to the industry weights in these factors, in the United States, quality is technology. In the United Kingdom, quality means basic materials and energy. So the industry composition of these factors itself then led to the quality factor behaving differently in United Kingdom compared to United States. This is the last slide we'll probably touch on, trying to delve into the factor performance and the industry composition leading to those factors. But the point again, you see, this is the attribution year to date of the value, quality, and the size factor. And year to date, technology surged. UK has minimum tech weight. And UK has a lot of basic materials and things like that, but those did not benefit from the rates staying flat. They actually got hurt by, the growth concerns and things like that. This is industry selection, so factors within the industry. In the interest of time, we'll skip over this slide. Now let's come to the factor valuations. So this is very interesting. You see again, FTSE UK on the left side, US in the middle, and Europe, developed Europe ex UK on the right-hand side. The main conclusions you will see that, yes, in general, US is always expensive, whether you're looking at the core benchmark or you're looking at each factor like value or quality. In general, US markets are more expensive. But on a time series basis, because the blue bars show the valuations right now, the black dots are the 10-year average. So you will see that US stocks have returned to their long-term averages, whereas UK and developed Europe still look cheap. Now, I just want to quickly touch upon, market. We often talk about the well-known indices, FTSE 100, FTSE 250. Right now, we were talking about the FTSE UK to have comparability across the different parts of the world. So I just want to point out the FTSE UK and the FTSE 100 are almost synonymous. FTSE 100 with its 100, and FTSE UK has 109 stocks. And on the right-hand side, you'll see the performance of these different indices, FTSE UK and FTSE 100. The lines almost overlap, almost synonymous. FTSE 250, which has a different exposure, it's concentrated much more on the smaller companies in the United Kingdom. That performed much worse. And on the left-hand side, when you see the industry weights, you'll see that the FTSE 250 has a big difference in the financials weight, where FTSE 250 has a much greater exposure in the financial sector for the smaller FTSE 250. Just a little bit, one cannot talk about equities without talking on the earnings forecast and things like that. So I just want to point out on the left-hand side is the EPS growth forecast. Obviously, for quite some time, the growth forecasts have been coming down. For the other parts of the world, developed Europe and US, there seems to be some kind of stabilization. The left line for the United Kingdom is still coming down. But when you come to the revisions ratio, how those earnings growth numbers, 12 months ahead earnings growth, are getting revised, that actually seems to have flattened. So it's a little light at the end of the, this earnings downgrade story. Coming to the valuation, this one I really want to touch upon, because on the left-hand side, you'll see the forward Ps for the United Kingdom and the developed Europe. You will see both the lines have turned up recently as equity markets have come back. But what is interesting is UK is consistently below the rest of the developed equities in terms of its valuation. And on the right-hand side, it's on a relative basis, UK to the developed. And then you see how it has consistently been coming down with some stabilization in the recent months. This discount of the UK to the rest of the developed world, it started in a very strong manner after Brexit, but it's now seeming to stabilize a little bit. Just one or two slides on the REITs factor. I just want to point out REITs have exposure to what happens in real estate, but also because it's listed, they have exposure to what's happening in the broad equity markets. So I just want to point out very quickly, on the left-hand side is what you have, the REIT index performance in different parts of the world in the last 3 months and 12 months on an absolute basis. And on the right-hand side, you again have the performance of the REIT indices in different parts of the world relative to their own geographic equity market. I've highlighted the EPRA REIT UK indices. The point being, if you look on the left-hand side, REIT indices in UK did much worse in the last 12 months compared to other parts of the world. And the reason for that is real estate is supposed to be an inflation hedge, but that happens when inflation is within some kind of medium bounds. And remember, we started the presentation by saying how UK has much higher inflation and a worse inflation picture than its peers. And that's one reason why the REITs in UK have performed much worse than their peers. We will not go into this in too much detail, but these are the different sectors specifically within the EPRA REIT United Kingdom sector series. And we see that the last 3 months, there has been some rebound in some of the hardest sectors like industrial and a few others. And this is my last slide because I just want to show on a risk return basis, how does United Kingdom equities compare to the other emerging other asset classes, both within equities and fixed income. And you'll see, so this is 1 year return on the y-axis and 1 year volatility on the x-axis. And you will see that on the extreme top right is developed Europe ex UK. As we started off by saying, developed Europe has been doing very well in the last 1 year. And right behind that, you'll kind of see UK and the FTSE UK and FTSE 100. So this kind of, in a nutshell, return risk, how does UK equities compare to other asset classes? And with that, I am going to stop my presentation. That's it.
Hey, thank you so much for sharing. It's really interesting and informative sharing from you, Indrani. So we have a couple of questions from the audience, so maybe you can just kindly address them. I will just verbalize out for you. So one client wondering like if we will we still continue to say the UK equity next outflow for this year? What are your views on it?
Because we are not an investment advisor, so I would not frame this as a prediction, but I would point out, so I'll point out to the trends that led to developed Europe and UK doing so much better. See, as we talked about, since the last financial crisis, it was all about US equities leading the rest of the world. And the primary reason was US is 30% technology, and we were in a very low rate environment. So in that environment, industries where growth is far into the future tend to do well. We have obviously reached now a world, even if the rates have peaked in this cycle, but the chances are given the inflation picture and everything, rates now and for some time to come will probably remain much higher than it was pre-COVID era. In that environment, it helps not to have a extreme heavy bias in technology. It helps to have a more diversified weight structure across the entire equity index. And UK and developed Europe have much more spread out weights and not concentrated on one industry that was really helped by the low rates of the previous economic regime, I should add. So.
Oh, yes. All right. Yes, it's really clear. And also maybe one more question before we jump to the end of the webinar today. So maybe you can share with our audience a brief thought on the REIT performance in Asia. Maybe a quick thought on it.
Yeah. So if we want to, it might make it easier quickly if we have that slide up. So you will see that on the left-hand side, the EPRA REIT emerging, it did much better than in the UK, like in the 12 months, the NEREIT, IPRA NEREIT emerging was down about 13 percentage points, while UK was down about 25 percentage points. So almost half. And the reason for that is emerging world had much lower inflation than we had been seeing in many parts of the world, and certainly compared to the United Kingdom, which had the really high inflation, which brings back to the point that we touched upon, that REITs, obviously they pick up the real estate exposure. Real estate is an inflation hedge, but it does well when inflation is within medium zone. So emerging markets had lower inflation than the United Kingdom, and that's one reason why their REITs did better than REITs in the United Kingdom. It's very related to the inflation story.
Awesome. Okay, thanks so much for sharing. So, yep, due to the time limits, right, on other question, we will be addressing them on via the email that you used to register the webinar with us today. And also, I want to show you our QR code to, So you can just scan this QR code above to access the recording of the webinar today. It will available after 3 working days on our social medias and also YouTube channel. And last one, so maybe this one is the, if you have first of all, if you have any sale inquiry or feedback regarding the webinar tonight, feel free to email to us at the ps@saxomarket.com. And yes, this is the most exciting part of today webinar. So we are giving out our door gift. So all you need to do is the first 10 people that email the promo code to us to the ps@saxomarket.com. We walk away with $20 commission credit and a door gift from Saxo. The door gift I already showed earlier during the webinar. You can rewatch again. And for those who that watch the recording of the webinar, feel free to like our social media and also let us know the first comfort shop if there is still the door gift still in stock. We will give it out to you. And okay, so with that, we coming to the end. So once again, Indrani, thanks so much for addressing all the questions. And of course, we know that from your side right now, it's really early in the morning. Thanks for the value of time that conduct a webinar with us today. And don't forget to say a big thanks to our audience spending their time to joining the session tonight. So hopefully after the session you get some useful investment idea and also can come to make your future investment decision. So with that, last but not least, I will want to share with you regarding the latest update from our Saxo. So I would like to keep our audience posted that from the 1st of April 2023 onward, Saxo starting to pay out interest on your next free equity in your Saxo account. So if you are a new client or you are an existing client and you are not aware of the updates, please check out the interest rate slider showing on the screen right now on the website for more information. And again, feel free to email to us at ps@saxomarket.com if you have any question. And once again, thanks so much everyone for joining today and have a good night. And always don't forget to stay invested. Thanks so much, Indrani. Yeah.
Thank you all for
Thank you.
attending.
Bye bye.